Hi, I'm Ariel Calero.
And my name is Beruta Scobie.
We're group number 7 and we'll be discussing large commercial banks.
A Regions Financial Corporation. First, we're going to start our presentation by briefly discussing history and the structure of Regions Bank. Then we will look at current situation in the economy and see how it impacts Regions' performance. Then we'll briefly discuss future forecasts and trends and summarize our main points in the SWOT analysis. And at the end, Ariel will tell you about job opportunities at Regions.
A brief history of Regions. Regions Financial Corporation was formed in 1971 as Alabama Bankshare Incorporated, Alabama's first multi-bank holding company. On May 1994, the company became known as we know it now, Regions Financial Corporation, to reflect its growing presence throughout the South. The company then merged with Union Planters on July 2004. Regions and AM South Bank Corporation merged on November 2006. Now Regions Financial Corporation, otherwise known as Regions, is a financial holding company that operates throughout the South, Midwest, and Texas. The company provides traditional commercial, retail, and mortgage banking services, as well as other financial services in the fields of investment banking, asset management, trust, mutual funds, security brokerage, insurance, and other specialty finance. The company operates in 3 segments: general banking, treasury, investment banking, brokerage, and trust and insurance. As of December 31st, 2008, Regions operates approximately 2,300 ATMs throughout the states they function in, and approximately have 1,900 banking offices in 16 states, including Florida. The company's executive is C. Dow Ritter, and is currently the chairman, president, and chief executive officer of Regions Banks. And he started in 1969 through their company's management training program, which I'll discuss later.
Okay, now I'll discuss the economy. As 2008 ended in the middle of rapidly declining economy, many investment banks, national lenders, and other financial institutions disappeared over the course of the year. The situation was reflected in main market indicators as Dow Industrial Average falling more than 5,000 points over the last year and reaching low 6,500s in March of 2009. Also, as of April, the level of unemployment peaked to 8.9%, and the consumer spending kept declining. So these rapid changes triggered an aggressive government intervention by launching a series of recovery programs. The Emergency Economic Stabilization Act of 2008 is also called the bailout of the U.S. financial system. It allowed the U.S. Treasury to spend up to $700 billion in buying distressed assets, mostly mortgage-backed securities. The program called Troubled Asset Relief Program. And this program allowed banks to gain access to inexpensive capital. However, it also allowed government to gain more regulatory power and impose limitations on banks' profitable investment policies or even salaries of top executives. Regions also received about $3.5 billion in these funds, which I'll talk about later. Another tool government uses to test the soundness and to control financial institutions is the stress test. It's a measurement of a bank's capital level and requirement to maintain it at a certain level to make sure that the bank is ready to withstand economic downturns. After the stress test, Regions was asked to raise extra capital, about $2.5 billion. Also, the Congress just passed new credit card regulations which imposed limitations on banks charging late fees, pay by phone fees, and other fees. These regulations did protect consumers, however, they limited banks to collect extra revenues in these fees. And the economy situation had a heavy impact on region's performance in 2008 because in their annual report, regions showed increased non-performing assets at about 1%. These are loans that are not accruing any interest and are not producing income to the bank. As the income decreased and expenses increased, mostly on provisions for loan losses, regions reported a negative net income for about $5.6 billion. Negative income led to negative return on assets, which were minus 3.9%, and negative return on equity ratio, minus 35%. These are performance ratios measuring how management is able to control expenses at a certain level of income. And it did show that regions had negative performance and negative return on shareholder investments. As the company experienced losses, the value of the company decreased and the price of the stock fell from $18 in September of 2008 to $2.50 in February of 2009. Well, currently the stock price is at $4 again. Another important ratio to discuss is the leverage ratio, which shows the proportion of bank assets that are financed by borrowed funds. The leverage ratio for regions increased from 6.6% to about 8.47% during the past year. It mostly happened because regions borrowed funds from the government.